Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us now is David Sowerby, Ancora Portfolio Manager, here with us on this Boxing Day. I guess not in the U.S., but around the world.
I'm
save
celebrating.
For you're celebrating, I know. But we're supposed to celebrate with the day off.
Canada, too.
Canada as well.
Yes.
Well said. The Commonwealth all.
My neighbor to the south.
Yes.
Right.
David, great to speak with you. And I want to start just by, before we look ahead, looking back on this last year, what lessons will you carry over from the way the market performed this year? And if you kind of think of this as chapters, how much is the story the same here going into 2025 for you?
Enough of the same, but one very good same is never underestimate the ability of solid U.S. companies to deliver superior capital allocation, shareholder value creation in the face of higher interest rates, questionable fiscal policy. Time and time again, bet on U.S. companies. That's been the rule of thumb for 30 plus years.
David, am I going to be lazy in 2025 and just hang on to my Mag 7, or should I take a little bit of roll up my sleeves a little bit, maybe take a look at some small caps, some mid caps, maybe some sectors or factors that haven't really performed over the past 2 years?
Well, Paul, I don't root against the Mag 7, but I think you have to think broader, more participation in the markets. We saw this rotation since July 11th where small caps outperformed quite well, value outperformed growth, the Mag 7 lagged, and here we go into December. Mag 7 right back on the treadmill. Small caps have still modestly beat large caps since July 11th, 10% for small caps up, 7% for the S&P 500. It's that two steps forward, one step back in December, but I think we're back to small caps having very good returns in 2025 relative to some of the mega caps.
David, count me among those who hears that watchword or those watchwords, small caps, and just sort of wonders what to do with it. Where are you looking? When we talk about small caps, where is there opportunities you see it? What's your counsel to your clients about what sectors, what types of companies are of interest in that world?
A proven process for 20 plus years. Two buckets to look into. First, spin-offs. Small company spins out of a larger company, unlocks shareholder value. Look at the Bloomberg spin-off index in 2024. It's up better than 60%. That's the first bucket. The second bucket is under-followed companies where there's only two or fewer Wall Street analysts following the company compared to the previous story on Apple. So an example is National CineMedia, ticker symbol NCMI. Only two analysts follow the company. They do that advertising when you go to the movies.
Hate it.
And you get there early and you see that captive audience for advertising at National CineMedia, over 1,000 theaters they're in. There's an idea for an underfollowed small cap stock.
And that stock's just ripped. It's up 60% year to date with a market cap of about just $625 million. So that thing has worked here. David, how do you think about valuation here? Because I've got a Fed that I think maybe they're going to cut a couple of times in 2025, but I think that's it. It feels like earnings have to be a real driver of this market going forward. How do you feel about earnings vis-a-vis valuation these days?
All valuation, rich. No other way to describe it. If you go on a free cash flow basis and value the market that way, not as rich, still opportunities for the investor. But you nailed it. It's a tug of war in 2025. Earnings, free cash flow, dividends will all be up 10% or better. That's pulling on the upside, but valuation is stretched. And I looked back to 1990. There have been 9 years in a calendar year where valuation went lower. And in those 9 years, the market only finished positive 4 out of 9 years when valuation slipped a bit. So that's the tug of war for 2025. Rich valuations, I hope they don't go lower, with earnings and free cash flow up double digits.
I could detect in what my friend Paul Sweeney was saying some disdain or eagerness to stop talking about the Federal Reserve as much as we have been over the course of this last year. What's the role that it's going to play in 2025 as you see it? I know you were listening closely to that press conference just a couple of days ago. How much is it going to be continuing to drive things going forward here as you look at valuations, as Paul suggests, other facets of investing beyond what the oracles down in the Eccles building are telling the market?
Well, You're in New York, so let's borrow from a famous New York investor, Reggie Jackson. The Fed is the straw that stirs the drink. So if the market only gets 2 interest rate cuts next year, I don't think the Fed should do any more. Their number one mission should always be price stability. And if the market doesn't like it in the near term, you have to grind through it. But at the same time, if inflation is not brought even a bit lower, just look at what the market did from 1965 to 1981. It was flat on an inflation-adjusted basis. It dropped 40 to 50%. So we have to be encouraging that the Fed stays committed to inflation. And that's going to be a story in 2025 in that tug of war relative to the, I think, favorable earnings, free cash flow, and free cash flow margins that'll still exist.
David, I've been doing this Wall Street thing since 1986. One of the really interesting markets to watch develop has been private credit. Talk to us about Ares Management Corporation.
Ares is one of the largest private credit publicly traded company, so bank loans in particular. And that has been an insatiable appetite for pension funds. I sit on the City of Detroit's investment committee, my alma mater, Wayne State. I chaired the State of Michigan Pension Fund for a number of years. The demand for private credit continues to grow because the expectations are you can get near like public equity returns without the same volatility. And that plays into a name like Ares, which is one of the largest private credit publicly traded companies.
Let's take advantage of the fact that you're there in Michigan. I'd love to get your sense of sort of not the politics of the election per se, but what issues were front and center, particularly in your home state, and what that tells you about what to focus on here in the years to come.
The economy, first and foremost. That cumulative inflation was up better than 20% since early 2020, 21. And I think that's why Michigan, perennial swing state, swung back for incoming President Trump relative to 2020, 2016. We end up voting with our pocketbook. The other factors matter, but I think that was the key reason for Michigan going back to Trump the way they did in 2016.
David, when you and your team woke up the day after Election Day, did you change your investment outlook for 2025 at all?
Generally, no, because I can't predict politics, Paul. My axiom in predicting politics is never expect Washington to do the right thing. They do the least amount to fix a problem. That said, after the election, you saw small cap stocks the day after popped 3 to 4%. That was validation that animal spirits were going to be resurrected, and we saw that November NFIB optimism index take a decided spike higher. That can be a factor that bodes well for the market next year, and in particular, animal spirits and small cap cyclically sensitive stocks.
You can't predict politics. Let me just ask you about geopolitics in terms of what you're watching and how that maybe colors your appetite for, say, assets outside the United States, equities overseas, other opportunities. Are you staying pretty closely focused on the U.S., or do you see opportunity across the Atlantic?
Outside the U.S., it's interesting, but the bias is still in U.S. domestic portfolios. And since the end of 1987, U.S. stocks have compounded five percentage points better compound annualized return, superior than the MSCI EFA. That goes back to the superiority of U.S. companies delivering shareholder value. The bar is high to have meaningful assets out of the U.S. You get enough diversification here, given our indexes.
So, David, what's your message to your clients? Do you have a thematic message to your clients for 2025?
I'm generally not that creative. Other than, keep your head down, find good companies that are generating capital and free cash flow to the investor. And at the end of the day, I'll have the same 5 risks that every Wall Street analyst has on the street. But ultimately, it's always going to be the risk you don't know that bites you the hardest.
David, do you still have clients who are on the more conservative side of things, who are part of that $6 trillion cash pile, who are reluctant to get back into this market? And if you do, what's the counsel you're giving them to jump in?
Generally, no. But if there are some, you just want to take a look at the potential for the S&P 500 or the average stock in the S&P 500 to compound 7 to 8% over the next 3 years. You're not going to get that in Treasury bills or Treasury notes. And the probability is probably better than 80% that the U.S. and the S&P 500, the average stock, will compound better than cash. I like those odds. The next calendar year, flip a coin. But the next 2 or 3 years, you feel like equities will still meaningfully outperform cash.
All right, David, thank you so much. We always appreciate getting a few minutes of your time. David Sowerby, Ancora Portfolio Manager from the Great Midwest.